Well, good morning, everyone. Thank you for making it out bright and early on the final day. I hope you're enjoying the conference and that you're feeling refreshed and energized for another packed day. And we're going to kick off with a panel that I'm particularly excited about. As Brian mentioned, something that's very important to us is the buy-side perspective. And I will allow my panelists to introduce themselves, but also to tell us a little bit about what you actually do in your day-to-day. So maybe starting with Lana.
Hi, thank you very much for being here and for the invitation. I'm heading the DWS credit trading desk for the EMEA. I've been in credit for almost 20 years now, starting in the corporate finance through the sell side, market making, to now buy side.
Kate.
Morning, thanks very much for having me. I look after global trading at Aviva Investors, and that covers rates, FX, credit, and so forth. And I started my career in foreign exchange in 1995.
It's not that long ago.
It is. It's a very long time.
Philip.
Yes, so I'm Philippe Bille, the head of the buy-side dealing of Degroof Petercam. So I have the pleasure to play at home today because we are Brussels-based. It's an investment house that manages over 70 billion euros. And well, my team, I'm the pleasure to head a nice team, and which is a multi-asset team. So while fixed income is of course an important part, but it's pretty much equivalently split between equity and fixed income.
Thank you. Niels Bohr, the physicist, famously once said, "Prediction is very difficult, especially when it's about the future." But that's exactly what we're going to do to kick off. In fact, I'm going to ask you to predict the future. So if you can go to your polling app, we're going to ask, which of the following do you expect to have the most impact on market structure over the next 12 to 24 months? And the choices are regulation, the growth of the bond ETF market, data and technology, and other. Maybe while you press the buttons on that, we can kick off with the first question. And in same order as the poll, I'd like to start with regulation. And the question I'd like to ask the panelists is, how do you see regulatory initiatives driving market structure over the next few years? And I'm thinking in particular things such as Basel III, FRTB, but also maybe other regulatory elements such as MiFID and increased transparency, consolidated tape. And maybe if I can turn to you first, Kate, to kick off.
Sure. So it's ironic that you ask us about regulation on the eve of T+1, which is one of the main things that we've been dealing with over the last year. But I think for me, regulation is the most important driver of market structure, following on from the global financial crisis. For various reasons, it never stops moving, but it's probably the largest and the most important driving force for what moves and changes our markets. And bizarrely, I think over the next 12 to 24 months, it's not buy-side regulation that's important, it's actually sell-side regulation. So specifically, Basel III endgame, and also the change to the GSIB surcharge, both of which we can expect in that time frame. So if you trade FX, you're probably aware of the changes to SACA that were made quite recently. I always get this wrong, but it's the standard application of credit and counterparty and credit risk. And broadly speaking, what they did was change the calculation methodology, which meant that even relatively short-dated, uncollateralized FX required a lot more capital to be set aside. Seemingly, inconsequential change, but actually has driven forward prices out. So small that you probably wouldn't notice, But in a market that's, $5.3 trillion worth of turnover is actually quite significant. So we've already seen, that's one example of how regulatory change can drive pricing and liquidity. And I think Basel III and the GSIB changes are much, much bigger in terms of their consequence. So from the GSIB's perspective, really, as I understand it, so I'm not in a bank, and both of these changes are what I would put in the category of really hard maths. Certainly, from my understanding, there are an awful lot of people at our banks that are working quite hard to make sure they've got the right data and the right calculations, because every minutiae of accuracy actually can improve the RWA position. So from that perspective, what we're talking about is really expanding how capital is calculated and put aside. And also, from the GSIB perspective, the changes there means that you're effectively moving from a cliff edge year-end calculation to a more of a moving average type perspective. But the two together are going to create, I think, probably for some institutions between a 20 and 30% increase in their RWA. And from my perspective, I can't see how that won't lead to a change in liquidity, or indeed a change in the price at which liquidity is provided. So now obviously this may change depending on the outcome of the US election, but broadly speaking, this is a direction of travel that we're going to be going in. And I think it will affect a broad range of asset classes.
So what I'm hearing is this is sell-side focused regulation on capital, but it's you, the buy side, who are going to feel the impacts.
I think everyone's going to feel the impact of this. To a lesser or greater degree. And it's certainly going to change, I think, depending on what you're trading, whether it's more or less attractive than it was before before this was introduced. So I think it's really important from a buy-side perspective to understand the value of your wallet and the ramifications to the banks that you're trading with.
Lana, do you want to add? Is this something you're feeling as well?
I mean, I completely agree with everything that you said. I think the biggest challenge is that there is so much structural change on the regulatory front that it's almost easier to track what's not happening than what's happening. And I think the biggest challenge is actually if it happens all at once, like a big bang, and the consequences of all of these measures could have that we cannot predict at the moment. I think it's important, whatever it will be coming, to give enough time, so a series of small actions, and to give the market enough time to adapt to whatever measure have been implemented, so that we don't have spilling effects and overlapping effects then on the broader market. I think the market is fast evolving, and market will evolve eventually in whatever comes. And generally, I think regulation is not good thing for the market, but the governance has to be done properly in order to not harm the markets and the liquidity, which will, at the end of the day, then harm the end investors.
And it's a confluence of regulation, right? It's not just FRTB and RWAs going up. There's other things going on. There's the consolidated tape. We mentioned T+1. Philip, how do you see the regulation impacting?
Well, for me, I think regulation is of course needed. We are all supportive of regulation, and that can really keep the financial system well in place. What I would be more critical about, I think there is some over-regulation, and maybe not over-regulation in the sense that there are too many regulations, but it's more over-engineered, too much into the details, which of course has a big impact in terms of costs and constraints. And as a buy side, I will look at the effect more on liquidity and cost of trading. So I know that regulation and policymakers really do focus usually on risk. Want financial stability. The banks cannot go bankrupt, even though, last year, I think a relatively small Swiss bank went into trouble. It was not a small one, of course, and everyone knows about it. So even though that regulation, those things still happen, but my point more seriously is that regulation tries to fight risks and try to have an environment where risk is very much controlled or pretty much disappeared, while a market is based on risk. And market is certainly the place that maybe, well, let's make it a little bit fun here. I would say maybe the market regulates the risk in the best way. It's not regulates, but the way it can transfer risk, the way it can price risk. And risk is very important in a market, in liquidity, having different actors with different views, different investment horizons coming together. And I think regulation is, well, by regulating on the side against risk, it has negative impacts on the markets. Negative impacts on the markets increases cost of trading and reduces the investment possibilities. And those two things add to the cost and actually lower performance for the end investor, which is actually the money well, we all manage for the future pensions, actually, of the population. So while regulation is facing risk on one side and trying to say the lending and the cash savings account, I will protect them, by increasing that cost of trading, it doesn't do a good job for the long-term savings, which are more the pensions, which, as we all know, are already today and will become maybe the major topic in the coming years.
And I guess risk is a bit like energy, right? You can move it around, but you can't destroy it. Let's check in on the poll and see what people are thinking. Okay, which of the following do you expect to have the most impact on market structure? Regulation, 30%. The growth of the bond ETF market, 2.9%. But I'm still going to ask the next question. Data and technology, we'll save the best for last, 64.4%. Other, 1.4%. Interesting. However, I think...
I would like to hear what's 1.4.
I'm going to guess that's like 2 people. I don't know. Let's go to the ETF market, because you can't really ignore it. When you look at the growth of bond ETFs over the last few years, in fact, in 2023, we saw $65 billion in new assets. It is impacting market structure. It is impacting liquidity. Philip, tell us how.
It's a challenging question for me after the poll, saying that the audience doesn't believe in it. Or
well,
so I will address it.
It might go up.
Maybe they don't. Maybe they don't.
Maybe they will change their mind after hearing me.
Exactly.
But well, to give a very short answer to your question, Andy, I would say that in my eyes, the bond ETF market has a significant impact on market structure and liquidity. Maybe not always visible because there is kind of more indirect ways. So I would agree that the audience, the way they answer the poll is maybe what comes really top of the mind. But I think it's worth to look into some aspects of the ETF bond markets. And just maybe to put it into perspective, you spoke about large inflows or increase in AUMs in 2023. Just maybe to put a few numbers, just rounding figures, and I think the absolute figures are not that important, it's just to give a picture for, and pretty much for some people in the audience who may be less familiar with that market. If you look to the AUMs in the bond ETF market, it's roughly $2 trillion in the world. And that's a big number, $2 trillion. It's not something to be neglected. But if you compare it to the outstanding debt, which is there in the fixed income markets, it only represents on average about 2%. So this is a small number. And if you look at geographically per big regions, in Europe it's slightly lower, it's 1.9%. In the US it would be around 2.8%, and Asia Pacific is quite lower at 0.4%. But if you look just the broad picture, it's only 2% of the outstanding debt. So this is small. But if you compare it, for example, to the equity world, there the AUMs of the ETFs represent already 10% about of the equity market capitalization. So I think it would be fair to assume, And like you say, there has been big inflows, so it's a growth. I think nobody can tell the contrary. So the inflows in the bond ETFs, it's really more, it's not exponential, but it's fast growing. So you can really assume that in the equity market, it's also there, continue to increase. So I would say the 2% could easily go to the 10% of the debt, outstanding debt, and could certainly go to 15, maybe 20%, who knows, in the coming 5-10 years' time. But where we'll reach, it's not important in what I want to explain. It's just that with 2% of the outstanding debt, you already see major impacts, what I will address just in a couple of minutes. But if with 2% you already have significant impacts, those impacts can only become bigger, more visible, more sizable, more impactful in the coming years, because we do expect, or I do expect, and I think the market does expect, that this is a growing, it's really a trend that will pursue, and you will see more of it. So now to answer your question after my small introduction, in terms of impact, what could I mention? I would say the first one, I think it's a pretty easy one. It's the fact that the growth of ETFs is actually a challenge, and puts pressure on the less performing or the bad performing active asset managers. So in that sense, the growth of ETFs contributes to the rise of the passive investment world, I would say both in relative terms, because it's growing and it's pushing some active managers away, and also in absolute terms, because actually it adds AUMs in a passive investment style. So I think this is the first impact, which I think, and there ETFs, I would say, contribute in terms of impact on market structures and liquidity in the same way that passive investment does. So there is nothing different, but it's just an extra contribution to it. A second impact, which is very visible in the market over the last 5-6 years, I would say, it's an impact on the market players. The large ETF market makers used to be, well, actually the big clients, or some of the big clients, or the large clients of the large investment banks. They moved away, pretty much. MiFID II had you could put this on a timeline as maybe a change of direction. Those large ETF market makers, well, are no longer the big clients of the large investment banks, but are today in the market and are large players in the cash bond market. And therefore, I would say there is a change, and this has different impacts, of course, on what those large investment banks had as a kind of very strong position. And I would say today there are some challenges around this, even though they are still, of course, they're still around, but their life is less easy. And we see that the large ETF market makers in the cash bond market have an impact, and we'll come to it, also have, of course, a big impact on the change of trading protocols. But, and there are some, of course, segments where it's more visible. I would say that credit investment grade is certainly an area where that change is very visible. Impact on liquidity, that's a core of the question. Impact on liquidity is, of course, very important, because you put more focus on the liquid bonds. So the liquid instruments tend to become more liquid, and the illiquid instruments tend to become more illiquid. So there is really a big machine which is there in order to emphasize the liquidity of the already liquid instruments, and therefore I would say the attention of the market really goes there. And of course, this is very much linked to, if you look to the in the ETF world, where the big AUMs, on which kind of ETFs, well, you will see it again in the bond market, in the cash bond market. And by putting much liquidity in already liquid bonds, you introduce some concepts that come more from the equity world, but you are going to a more order book style in some of the instruments. Yes, and you also have a rise in the auctions, which is also pushed by this phenomenon. And finally, to conclude, I would say, and this is a big topic, of course, but I think we will elaborate more on this, it's all the impact on the trading protocols. It's not only coming from this, but it has been a main trigger to put this in the cash bond market, and certainly to accelerate their development. All concepts some coming from the equity world also, which is the presence of algos, program trading. Then you have also new concepts more in the fixed income world, but it's list rates. And of course, everything, well, some protocols, for example, request for market, so where you don't disclose your size, you know, not the traditional sales guys speaking, you know, you should buy this, and by the way, I have this in inventory and I can offer it. No, a request for market where you don't disclose your size is kind of the per default trading protocol in the ETF world, which now becomes also very present in the fixed income world. And finally, of course, everything, you know, that pushes the electronic trading, this pushes, this facilitates or make it possible to start with automation, for example.
So what I'm hearing is that the ETFs, they're not just creating an alternative form of liquidity, they're bringing in new liquidity providers, they're affecting the liquidity of the underlying market, but there's also a segmentation between the more liquid bonds and the less liquid. The more liquid,
and it's maybe
more like equities.
And it's maybe why the agents put a very low score on that impact, because I think there is no one single visible impact of the ETF world. Like I tried to explain, it's very widespread on different ways. There are some where the ETF world is more the main driver, and in some other aspects, it just contributes to something which already triggered by other aspects.
So in terms of the impact on the, I'm really interested in how it's impacting the underlying and this segmentation of liquidity. Kate, Lana, how do you see this in your world?
I think he's right to be flagging it, right? If we think about the last 20, 30 years, when you see, you know, where any asset class where the bigger banks have moved away, you need to understand what's driving that. And I think it feeds into the point you were making about the consolidated tape. You know, we're kind of in this sort of thought process where we're after transparency, we're after more data, you know, but really data and transparency may not actually create more liquidity. You know, we've got to be careful what we wish for, so to speak, in terms of especially that subset of bonds that Philippe's talking about, which are becoming more illiquid.
Okay, that's interesting, and it's a nice segue into what we saw from the poll. People think that data and technology is going to have the biggest impact. Lana, how is data and technology going to have an impact?
Yeah, I mean, just coming shortly to the ETF, I mean, it brought us to the point of no return, right? The ETF or the underlying processes happening with the redemption creation processes got us to the point where markets were in the need of a new technology solutions, were in the need of the ways how to handle this new liquidity. We have seen the decrease of the sizes of tickets, which also somehow correlates with the decrease of the issuance sizes in the corporate bond market, for example. So it's then brought a lot of data points for the sell side to be able to easily interact with risk, more easily interact with risk, which also made more easily accessible fixed income markets, which was for a long time not very prompt for the retail investors, a little bit more open. So it's just like a circular way of how the market is evolving and how the increase of the ETF is increasing technology and increasing risk appetite on the other hand side. I'm definitely in the camp of technology and the data from the aspect what will mostly influence the structure of the markets in the next couple of quarters. But there I also see a lot of challenges that we have to prevail. I mean, we obviously seen a lot of the new technologies coming into the game, the sell side introducing different ways of machine learning techniques into their algorithmic trading. We've seen venues coming up with all sort of models that include even the AI at the moment. We've seen the buy side being able to calibrate their automated routing systems that were up until now very static to more dynamic, to more vivid models, also to be able to grasp this increased liquidity in the fixed income markets. But I do believe that it will be extremely important to handle it in the future, especially from the data perspective. The challenges that we are already now facing is, for example, what I am facing at the moment is a price tag on the data. So not only getting the data on board is a difficult and a pricey thing. I think it's also important to develop a governance model around what data do we have on board and how we take care if that data is something that we need. Is it what is the quality of data, and to be able also in the process of the lifetime of this data plug that we have to decide sometimes when it's the right time to plug some of the data out. So that's, I think, one of the biggest challenges that we are facing at the moment. What we also need to be able to be more interactive on this technology front, especially from the buy side, is have a prediction and abilities about transaction costs, for example, which are currently really hard to measure. I mean, if you look at just simple numbers from the US, I mean, bonds trade rarely. From 60,000 bonds that are in the trace to only 24, I think, traded 240 days in the last year, and more than 50% of those bonds trade once or less times in a year. So it's really hard to predict what the sentiment for a specific issue will be. And that's one of the biggest challenges that we are facing, how to incorporate this sentiment measure into how to quantify this sentiment measure in the board markets. But this is one of the biggest challenges, but I'm sure that the market will prevail that, and that we will, with this increased liquidity, be able to evolve to even larger concept of technology driving fixed income markets.
That's really interesting, and I want to explore the data or the use of data a little more, and how that feeds into automation. But I'm just going to take a step back. One of the things I'd also really like to know is how, with the introduction of new protocols beyond RFQ, how is this affecting your trading? Are you using new protocols? Are you using order books? Are you using portfolio trading, etc.? To what extent?
Absolutely. I mean, all of these protocols, the new things that came into the market in the last couple of quarters have made a lot of difference, and I think the whole market is adapting, and it's a learning curve for everybody. So we have stages where one protocol is very well used, and then we have a couple of quarters where nobody wants to touch it anymore because at the end effect was more costly than the benefits of it. But we are still all learning from that and trying to evolve into a more comprehensive way how to use it in the future. And I think the portfolio trading is one good example of that, because everybody jumped on the board some 2-3 years ago. Everybody wanted to be in the game. Then suddenly everybody stepped out to realize that it's very costly. On the sell side, for the buy side, it was costly to execute rather than automating the tickets or sending them line by line. So we all stepped out, we learned from that experience, we developed new models, how to try to analyze and predict some of the costs, and now we are again all very much hands-on the protocol, and it's bringing a really good result. So this is one of the great examples how the market is evolving and how we are all learning together.
And in terms of the greater automation, to what extent is it really just creating efficiency, and to what extent is it actually creating liquidity? And Kate, if you have any thoughts on that.
Well, so we'll take this back to regulation, but I will. If we look at MiFID II, what best execution means, really it means continuous improvement. It's about constantly adapting your process. So if you aren't changing, if you're sat still and you're using the same protocols to trade that you have for years, you're not actually performing your regulatory obligation to deliver best execution. That's the first point. So you have to try. Portfolio trading, for me, that really feeds into the whole point about data, because it's really about the pre-trade. It's about taking in the right information that you need to go, is this the right protocol to use, right? And if it is, have I got the right lines? Do I need to go with all of these lines or some of these lines? Do I need to take these out? What is going to get me the absolute best result? And that's one of the reasons why data across the piece, not just external data, but using your own data is super important, because that will inform when you use a specific protocol and when you don't. So I think these three topics are actually all interconnected.
And I don't want to dwell on it for too long, because it was something that was covered on a panel yesterday, but we can't ignore it. To what extent do you expect the consolidated tape to actually aid with the innovation and with getting better results for client outcomes? Philip?
Well, I think consolidated tape is certainly important to have a better indication where the market has traded. So this is today, I would say it's still a challenge. I would say it's still a challenge to know really say it's in the bilateral discussions, you don't really know what the output of, well, the market doesn't know the output. The people having this on their inventory, they don't want really to disclose what they traded at what price and which side. So which is also a reason why it affects trading protocols, because some people say, okay, if you ask us a price in this way, it will be less competitive because it gives more information to the market than if we trade in another way. So I would say consolidated tape is, of course, an important concept, but let's see how it, the side effects of it maybe. So I think it's something which is only normal as a market to know where the market is, where the market has traded, and where the liquidity is. I think for me it's very important that it will add well, we spoke about quality of data. It's really there that it plays an important role, because I think this is really a data you can rely on, which today you face with prices in the market which are not real prices. You have access which are not real access. You have things which are real. So I would say at least a consolidated tape would at least flag some real prices.
And clearly one of the uses of data, as you've mentioned, is being able to drive algos, which have become a much more important part of the market structure and looks set to continue. Apart from the benefits, is there also a potential vulnerability when we're relying on algos for pricing?
I think you just need to bear in mind that the algos are attached to a bank, right? So your pricing is still coming from the same liquidity provider that it always has done. And I think it's worth bearing in mind that we don't think of e-trading as separate to voice trading. There is value in your relationship. There always will be value in your relationship, regardless of how you're trading. There's a really interesting Bank of England white paper that came out November last year, where they actually tried to quantify the benefit of a working relationship with your counterparties in the corporate bond market. I don't know if you've seen this, but in normal market conditions, the number that they've estimated is 4.6 basis points of that being in that sort of tier one relationship. And in distressed conditions, it's up to 10 basis points. So I thought that was a really interesting piece of work to actually kind of put a number on it. So I think it's just worth bearing in mind, data, pre-trade, algos, efficiency, all of these things are sat on top and are complementary to your sell-side relationships.
Okay, so we still need market makers, we still need sales.
Yes.
I think it's very important when we speak about all those topics which are trading protocols, which are quality of data, whatsoever. We all know that the bond market is not a single homogeneous market. You really need to tackle it per segment, per region, and it's very important. In some areas, sub-segments, you have a trading protocol which is very efficient. You have a pricing which is very qualitative, and you say you know what the exact data is. You can in sub-segments, trading protocol, like I say, it's very efficient. It's maybe algos can be very performing, but they will be absent in another sub-segment. So I say when you speak about those concepts, I think it's very important that we don't think that there is for sure not one size fits all approach that can be followed. But therefore, as a buy-side desk, it's very important to have all those tools, to know them, and to use them appropriately when they add value, and certainly to avoid them when they they don't achieve the best result for you. So for me, it's really like, you have a big patchwork, a big puzzle, your toolbox, and you need all of them, but use them when it's the best, and of course, even market conditions or volatility play an important role there.
Okay, I like that. It's a patchwork. So we've talked about how automation, electronification is impacting the secondary market. Where do we stand with the primary market? And Lana, if you want to start with that one.
But I think we are finally getting somewhere in the primary market arena, because for 30 years we have been doing the things the same way all over again. And I'm very happy that the technology has evolved enough that there are some players that are offering ready-to-use solutions for the buy side specifically, which will make our life much easier. So I do see a progress, and I do see that dependencies on the technology are actually adding value to our processes rather than taking them away. And I don't see going back from where we stand now. I just see expanding the universe of the technology that will help us into be smarter trading platforms for our investors.
Are you finding the same? Are you seeing progress?
Well, there is progress, there are solutions, but it's still, like I say, it's so surprising. Well, not surprising because we know some of the reasons behind it, but when you see how important primary markets are for the bond market, it's the size and the amount of issuance. It's amazing that you don't have there a single technological easy solution, because it's not something complicated. And it's just something which is refrained, and I would say it's, like we spoke about regulation, I don't say that the regulator needs to jump in, but it's very bizarre that that very important market is left in such a manual way, and where, it's pretty much still people putting an interest in an IB chat, someone on the other side putting in an internal system, and then a syndicate in an Excel sheet trying to select your tiering and your allocation, and maybe, with the wrong someone inputting something wrong in the system. Well, that's your allocation, and tant pis, it's what you get. No, so I think it's very bizarre, it's very surprising, and I think we should really have this collective ambition to go to a very good and robust solution. Well, we know there is some reluctance on the syndicates, because we know that in subsegments, in some regions, well, the fees are still very important, and they are pretty much justified by the fact it's a very complex thing to handle. Why it should not be that complex. We also know that on the buy side, even though the buy side is pushing for having good solutions, but some of the buy sides may also want to protect their better allocations. And I say, if everything is very streamlined in a technological way, maybe that all those things will become, based on your tiering, you will have an allocation, and you will have the same allocation than someone with the same tiering, which today you may want to have a better one. So I would say, okay, it's not, you cannot point finger or do some finger pointing, to a specific part of the ecosystem, but it's for sure that we all would love to have this in a robust electronic way. Yes.
And that's an interesting point as well, and it's one of the observations from where I've sat at ICMA over the last 10 years, that a lot of the innovation has really been driven by the buy side. And with that in mind, and we're going to have to wrap up, if I could ask each of you to look forward, make a prediction, what one thing do you think is going to really change the way that you're trading over the next 2 to 3 years? Lana.
I think the machine learning it's very popular to say, but I do think it will have the biggest impact, and it potentially a big bang in the technology that impacts the markets.
Okay, other than machine learning?
So I think I can't control the direction of travel from the regulation, so I think I'm going to concentrate on what I can control, which is very much about using data, being smarter, helping our trading team make better decisions. And whether it's machine learning or some variation of that, it's definitely about having better tools.
Philip?
I would say, even though on one side, because we haven't mentioned it, even though it remains very important to have very good relationship and human and business relationship with counterparts and the human world. So this remains very important. But for me, what I expect most from it, it's really from the data world, and I think line with you, whether it's machine learning, it's artificial intelligence, whatsoever. But it's really the way that, thanks to data, you can really optimize on your pre-trade process. Okay, you can lead to automation, but I don't really like the word automation because let's say a one-click automation maybe but you really have so much information coming from data that you know that you are taking the best decision involving the best counterparties in request for quotes, or you know where the pricing is, and therefore you can really optimize what you do. And actually that's our goal, common goal on the buy-side investment desk, is to generate alpha for the clients.
Thank you. Well, thank you all for joining us early on a Friday morning, and please join me in thanking our panelists.